Welcome to Coffee and Keys, where we blend our expertise and personal experiences to unlock your awareness of the real estate industry.
They're the best.
Here they are.
And now, here's your hosts, Darlene Kemp and Jacques.
Hey, hey.
Hello.
Hello. It's been a while.
It has. This is going to be a great topic, though. I think it's a topic that a lot of people have questions about, and we kept saying we need to find a topic, and I think this is a great one. So we actually have a guest speaker on today, and she is going to help us talk about reverse mortgages. So we have Laurie MacNaughton. And she's been doing reverses since 2006. And so I think she can shed a lot of light on a lot of those questions, right, Crystal?
Yeah. So the exciting thing about it is everybody knows that I'm a dual agent. I'm licensed in 2 states. And one of the states that I'm licensed in is Arizona. And Arizona has a lot of seniors, you know, maybe not more than any other state, but it seems to be,
Retirement place.
Everybody's chasing that sunshine. So this is a topic that comes up quite frequently. And me not being an expert in it, we decided to get somebody that is.
Oh, great. Yeah. Well, why don't we just jump right in? And as we were talking before we started recording, I think the biggest thing to understand right off the bat is you can do 2 different things with a reverse mortgage. If you're living in a home already and you feel like this is a good place to age in place, or you want to stay there at least for the next few years, we would talk about doing a reverse refinance. And how I think it's easiest to think of this is imagine your home is a great big old-fashioned pickle jar, the kind we had to reach our whole arm down in. And we're going to put a belt around the tummy of that pickle jar. And where that belt goes is based upon the age of the youngest homeowner. Everything below the belt has to stay in the home. So that's equity that stays in the home. The only way to get all the pennies out of the pickle jar, of course, is to sell the home. Then you're picking up the pickle jar, you're dumping out all the pennies. But we've established the fact that for right now, you want to stay in that home. So we're going to put a belt around the tummy of the pickle jar. Everything below the belt stays in the home. Everything above the belt becomes a line of credit. You can access those pennies as a lump sum if you have need of a big chunk of cash right now, or you can take it as a monthly stipend. A little bit comes out automatically at a time, or you can just leave it as a line of credit. And that's actually my favorite way to see people do it. They have a big old line of credit. They reach into the pickle jar and just take out some of those pennies as needs arise. The name itself, reverse mortgage, comes from the direction of repayment. So when the last person on title no longer needs the home is sold, whatever's been borrowed gets repaid, the rest of the pennies belong to the homeowner or to their heirs.
Okay, so let me ask this question. When we say reverse mortgage, because when we say mortgage to our clients, they're making a payment to the bank every month to own this house. Now we're going to reverse this, right? Which means in the world of reverse mortgages, it means that
it's just the direction of repayment. So a traditional loan, not making this up as funny as it sounds, a traditional loan is called a forward mortgage. So you're actually making payments as you go. With a reverse mortgage, you don't pay. The home itself pays back what the home owes on the back end in reverse. So it's a mortgage. Whatever you borrow from the home just gets added to the loan balance. And then at the time the home is sold, the loan balance is repaid. The heirs get the rest.
So does that mean that the bank pays you if it's reverse?
Well, so a line of credit. So if you think how any home equity line of credit works, is the bank paying you? Well, in a certain sense, yes. So any line of credit works very much the same way. You've got equity in your home. You're pulling out some of that equity. It's a home equity line of credit. A reverse mortgage is exactly the same. The difference is, I'm going to take the top off my little illustration pickle jar here. The difference is with a traditional line of credit. So one question I get asked a lot, I'm going to back up. One question I get asked a lot is, well, if it's just a line of credit, why not just do a line of credit? And here's the thing. So let's say somebody does need in-home care, and we'll just use the national average of about $7,000 a month. So let's say you have a traditional line of credit and you start taking out money, $7,000 this month to pay in-home care. Well, everything is fine. You're in a much better position for 29 days. But on day 30, what happens? Well, on day 30, you have to start repaying some of that. And the next month, you need another 7,000. The month after that, another 7,000. So your month-end repayment obligation gets bigger and bigger and bigger. And this person already needed better cash flow in order to pay in-home care.
That's right.
So with a reverse mortgage, the only way really to break that cycle is if you have a reverse mortgage, you're allowed to take out that money as needs arise, but you do not have a month-end repayment obligation. The home itself repays what the home owes when you no longer need the home.
So you're using your asset that you purchased to take care of you on the end.
Exactly. You built up all that equity and now you're using some of that. And I hope this isn't too earthy of an illustration, but if you all are mothers, you have a baby, and that baby has a placenta, and that placenta is an actual human organ, and it's cushioning the baby, it's protecting the baby, it's feeding the baby, and then the baby's born. And what happens to that placenta? Well, it doesn't have a life of its own. That placenta goes away. It's been used up. What has happened with that equity? First of all, it'd be very difficult to use up all the equity in a home, but that home has protected those homeowners. It's provided for those homeowners. It's cushioned them. It's done, they built up that equity, and now they're using some of that equity to provide for themselves in that chapter of life. All the rest of the equity still belongs to them or to their heirs, but that was their equity, and now they're using that equity for such a time as this, for a time at which other assets may have been depleted. And for such a time as this, they now have that big old line of credit from the equity they established to provide for this chapter of life.
Interesting.
And I always say, when it comes to aging in place, and there's a lot of people that say, I don't want to move. I've lived in this house. I know my grandmother, we just lost her this year, but she was 102. And I will say that we all just wanted her to, enjoy the final years of her life. And she was able to do that in her home, and, it's great if they've got the money or saved the money. But if you've got all that equity in the house, there is expense, because at the end, she did need that in-home care. She did need all that, assistance in the end. And I know all of us were like, we weren't thinking about when she passes and the house now is to the heirs. We all wanted her to have everything that she can. And if you don't have kids that can support them in the older ages, then that's what the equity in that house is for. It can go for something good to help them, survive those last years of their lives. And most of the time, kids want their parents to enjoy the remaining time that they have the most comfortable that they can. And if it means using their equity, most of them are fine, with that. They're using up that equity. Then I know one of the biggest things that we hear a lot is that they want to leave their house to their kids. They want to leave an inheritance for their kids. And that's one of the biggest reasons, that people are fearful a little bit of these reverse mortgages. But I think when you talk to the kids and get them to realize how you really utilize the money and the equity in your home now, it just kind of doesn't make any sense not to, and because you can't take it with you. Right. And Darlene, there's actually even a bigger consideration there. So a reverse mortgage, because it's equity and not income, that is tax free. So what they're taking out is not
that's a good point.
If somebody has, let's say they've got an appreciated 401k and they need $7,000 a month. They're not taking out of that 401k $7,000 a month. They have to take out almost twice that because they have to pay taxes on everything they've taken out.
And there's penalties.
depending on their age. There may not be penalties after a certain age, but there's certainly taxes no matter what you do. And here's the thing. So let's say mom and dad have gone through their IRAs or their 401ks. And now what happens? Well, the adult kids are up to bat. And so now there probably is going to be a penalty if the adult children are drawing from their 401k before they're allowed to age-wise. They're going to be paying taxes on their own 401k and penalties to bankroll mom. And one of the cruelest things I see in the entire course of my career is adult kids who have prematurely drained their own 401k to pay for mom's needs. I have an article I wrote called The True Cost of Bankrolling Mom. So if let's say you're a 60-year-old adult child and you're bankrolling an 85 or 90-year-old mother, you're draining the 60-year-old is draining her own 401k to bankroll mom's care, which then means when the 60-year-old daughter gets around to retirement, she doesn't have a 401k to draw on. So she's kicked the can down the road and her kids now have to step in and bankroll her. But if mom had done a reverse mortgage and had used that, it would have broken that cycle. Mom would have been self-paid to the end of life, enabling the daughter now to be self-paid to the end of life, which then enables her kids to be self-paid to the end of life. So what we're all doing, I've often had this vision of, as women, we're kind of linking arms and marching forward into the retirement years. One of the ways is just by having a good understanding of how finances in an aging America works and how we best can protect our children who are coming up behind us and whose retirement likely is going to be even longer than ours. So the reverse mortgage is really, as much as anything, it's a wealth management tool, not just for mom, but also for the generations yet to come.
So we've spent a lot of time on our podcast saying, that purchasing a house is building wealth. You're acquiring an asset. It's just not a place to live. So this is the perfect example why.
Of building wealth.
Absolutely.
It's just a way for you to be able to access those funds, because your equity is, a lot of people think, well, what is equity really? Well, your house is an asset and it has value. So your equity is the difference between what you owe and what the house is really worth. But the only way to get the worth is to sell it, right? Or to borrow against it. So this is just a way to borrow against that wealth without having to pay it back. While you're alive.
Mortgage payment.
Right.
Exactly.
While you're living in the property.
Using your asset.
It's yours using your asset without having to make payments back to it when you need it in the elderly years, I think is
So it's not necessarily a negative thing, because there's a lot of negative connotation that I hear as an agent when you say reverse mortgage. And like we were discussing before we went live, is I had a client that they were the perfect example to get a reverse mortgage. And what did they do? They chose to drain their bank account and pay off their asset.
Yeah, and actually,
instead of getting a reverse mortgage.
Yeah, and I actually remember working with them on a little bit, and they actually had a house that, it was a large house with a large yard, and they just couldn't take care of it anymore. And he wanted to kind of be on the golf course and things like that. So they actually, used a mortgage to purchase it, and then they were going to do the
paid it off.
And then they turned around and paid it all off. Where if they had done the reverse mortgage, when they sold that house, they could have taken the equity from that house. But instead of just like taking all their money and throwing it into a house paying in cash, because that really kind of left them without any liquid assets after that. Yeah, they were right.
Yes. And they are the ones that wanted to leave money to their children.
Yeah,
but they just used it.
So that's
all
actually,
in the house.
That's not an irretrievable situation. So is what they've done, and we're actually transitioning from the refi into the concept of a purchase. So let's review how the reverse for purchase works, and then talk about what this couple's scenario could have looked like. So, for purposes of illustrating the reverse for purchase, let's just assume the couple has already sold their big house with all the steps and too much yard and goose poop in the driveway or whatever. They actually had somebody.
Have you been there?
Yeah. They want to get into an aging in place appropriate condo or single level living and smaller yard, whatever. So you've already sold their big house for them, and they've just put, I'm making up numbers. Let's say they just put $800,000 in the bank from selling their exit property. They could turn right back around and purchase in cash the new home. But then they've taken $800,000 and they've tied up a whole bunch of that liquidity in an all cash purchase. And there was a study done a number of years ago by National Institutes on Aging. And the conclusion of the Spiegel report was access to liquidity is the single biggest indicator of financial survivability in retirement. And I just love that. Years ago, I memorized that because it's so powerful. So if you've just done an all cash purchase, you had liquidity, for a hot minute, you had liquidity, but now you've turned all that liquidity into illiquidity by dumping it all into the new home. However, even for the person who did that, they can now turn back around and do a reverse refinance and pull out some of that money, but that's costly. Now they've had to go through two closings, one to purchase, one to refi. And it's just
these loans aren't free, is what you're saying. You've got to pay.
Oh, they're closing costs. Sure, they're closing costs on any mortgage. Yes, exactly.
Okay.
Exactly. So why pay the state and the county, and in some cases the feds twice when you could have just paid once? So how does reverse for purchase work? So again, for this scenario, they've already sold their big house. Now you found them the perfect aging in place house, and we're going to picture that also as a pickle jar. Mm-hmm. We're going to put a belt around the tummy of the pickle jar based upon the youngest home buyer's age. When they come to the closing table, they're going to dump in all the pennies below the belt. That's going to be their down payment. And it's not going to be 10% or 20%. It's going to be more like 50 or 55%, depending on the age of the home buyers. But we as the lender are going to dump in the rest of the pennies into the pickle jar. So down payment plus loan amount equals purchase price of the home. Mm-hmm. I call that the big no duh.
No duh.
But they're done. They're done. They've just made the only payment on that home they'll ever make.
So
when
now they don't have
to make last person on title dies or goes into a nursing home or sells the home and moves to, Portugal. At that point, so when the homeowner no longer calls that home, they'll sell the home. The loan will be repaid. The homeowner or the heirs will get the rest of the pennies in the pickle jar, including all appreciated value of the home. The lender doesn't get the home. The lender doesn't get the appreciated value. The lender gets what the lender lent out. The kids get the rest. It's kind of the shorthand. Then there's just one closing. There's a closing to purchase the home. They have retained much more liquidity from the sale of the exit home. They haven't poured it all in and for an all cash purchase. And they have no monthly mortgage payment. So it's a perfect wedding of the concept. You haven't tied up all your liquidity, and you can move forward without a mortgage payment. And the significance of that becomes profound if one spouse predeceases the other, because the typical scenario, if they bought with a mortgage, one spouse typically dies before the other, and now the surviving spouse has half the income, but all the debt. And in many cases, they can no longer afford that mortgage payment. But if they had bought that home, they've got liquidity and they've got no mortgage payment. So they're safe, sound, and secure in that home, even if one spouse predeceases the other.
So what you're describing to me is like a win-win situation.
Yeah, and depending on how you do the math, it could be a win-win-win-win-win. So it's a win for the homeowner, right? It's a win for the homeowner, and often they can afford a more appropriate house because they're not trying to finance the whole thing, or they're not trying to pay cash. So if they thought they were going to buy something that was $400,000, now they can buy something that's $650,000 that has more aging in place amenities. That's a big win. It's a big win for the homeowners themselves in case one spouse dies. They're not going to launch their wife or their husband into the future with a home they can't afford. But then it's also a win, of course, for the adult children, because they don't have to worry, are we going to have to step in and start paying mom's mortgage payment? Or, now are we going to have to, whatever the scenario might be for the adult children. So yes, I agree with you. All that goes to say yes.
Okay, so and we kind of hit on a lot of this. I hope we're clearing up some of the misconceptions. Yeah.
Yeah. And
Yeah.
Crystal, you had asked earlier, it's like, what's the deal with the bad reputation? And I would like to just kind of address that for a
And the
second.
misconceptions.
Okay.
Yeah.
And I was telling you two ladies, I started off as a chemistry teacher. Then when I got to the point, I just couldn't muscle through a teacher because
Chemistry?
that wasn't the issue. It was more the parents of my students were kind of, this was, a long time ago, and the parents were bullies, and I was so young. So anyway, left teaching. And then I started working as a technical writer for an adoption firm, for a law firm. And when I got a call back in the day from a headhunter who said, "Oh, we've been given your name. We'd like you to come in and interview for a position as a reverse mortgage specialist," without really thinking about what I was saying, which will become clear when you hear what I said, but it just came flying out of my mouth. I said, "Reverse mortgages, are those things legal?" Because they have a predatory or a back alley or a desperation aroma about them. And we're all
Misconceptions.
Right there. I started off there. We all start off there thinking there's something the matter with reverse mortgage. I can't remember what it is, but there's something almost evil or predatory, right? Don't you?
Yeah, there was some misconceptions on it and some things when they first came out years and years and years ago that really didn't protect the buyers. But now these are loans that protect the buyer, protect the lender, and everybody in place. So you're absolutely right. They have some misconceptions without people even realizing what those misconceptions are.
100%, or where they started off. And I think the best way to understand that predatory impression we have is because they used to be predatory. If you were to go back to the 50s and the 60s, even in some cases into the 70s, there were lenders out there who were really just nothing but loan sharks. And it's how it initially worked. If you go back far enough, is there were groups that were called investment clubs, and they would comb the obits looking for recent widows.
I've heard of that.
Yes. What did they call that? Reverse mortgage. So they would go to these, and you don't really think about this, but the widows of the 60s were the housewives of the 50s. And in many cases, those women were financially very unsophisticated. Their husbands had just handled it all. Mm-hmm. So here they're a widow in the 1960s. These investors would go to the woman and say, "Look, we'll take care of you. All you need do is turn over to us title to your home and all will be well." Mm-hmm. But of course, it's just, they didn't realize that who held title owned the home. And then if she lived longer than they thought she should or thought she would, or if the home went down in value, they didn't even have to foreclose. They could just evict her. And if the home couldn't be sold for what they had lent out, they could come after her or her heirs for the shortfall. So the two things we all think, and I put myself squarely in that camp, the two things we all think is the lender gets the home and the family ends up in debt. Where does that come from? And why do we all think it? Because
way back
when the concept first was adopted in the U.S., the lender got the house and the family could indeed end up in debt. It hasn't been that way
or lose the house or get evicted or any of that. But yeah, you're right. So that, and I think that's where a lot of people think that they either don't own the home or that they could be, evicted, or the house could be taken away from them, or however that might go. But there is no payment on it. They obviously have to pay taxes and homeowners insurance. So there's still that debt. But, the lender is not going to take the house back because it's either, doesn't have enough value in it, or they haven't made payments, because there's no payment required, and it doesn't matter what the value is going to be. They could live to be 102 and still be okay and not be taken out of the house. So the lender's not going to be the one that's going to be taking that house away. Correct.
So
correct. And actually, you suggest another topic, which is very profound. If you owned a home outright, just, Mrs. Smith owns the home outright, could she lose that home? She owes nothing on that home. Could she lose that home?
Real
Yeah,
estate tax.
there's always a possibility.
How
Or
would she lose the home?
She doesn't pay her taxes.
She doesn't pay her taxes. I cannot tell you how many times I've taught classes on this and people have said, oh yeah, well, if reverse mortgages are so great. I know a lady, she had a reverse mortgage and she lost her home. Well, as a reverse mortgage specialist, I know something about that lady that the person telling me the story doesn't know about that lady.
Yes.
I know that lady didn't pay her taxes. And it's not that, the lender is sitting there hovering. The county will start a tax foreclosure on a property because paying taxes and keeping the home insured is not a function of a mortgage. It's not a function of a traditional mortgage or a reverse mortgage. Paying taxes and keeping the home insured is a function of home ownership.
That's right.
No matter what you do, unless you qualify for a property tax waiver, you still have to pay your taxes and you have to keep the home insured. So if somebody's gone into foreclosure, you can bet dollars to donuts that the reason was there was a tax deficiency there that was not corrected, that was not remedied. So you can indeed lose a home with a reverse mortgage if you don't pay your taxes, then the tax man comes a knocking.
So the number one misconception,
lender.
and we did hit on it, but we didn't, get the answer. And so I just kind of want to make sure that we get this answer. The number one misconception that I hear as an agent is I don't own the house, the bank does.
Yeah, that is a common, and it's not true. So the home always remains titled in the homeowner's name or in if they have a trust, then it goes into their trust. So yes, it's always titled in the homeowner's name or the homeowner's trust.
So the second misconception that I hear is reverse mortgages are only for people in financial trouble.
Yeah. I think I was mentioning that I call that the old, the poor, and the sick, or the, desperation. And there is a whole term for that, and it's called a rescue reverse. So I do rescue reverses? Somebody's gone through all their other assets. They're down to their last penny. They can't afford the taxes or, whatever the case may be. Do we do reverse mortgages for somebody in foreclosure? Yes. I do a significant number of rescue reverses. Not the happy face reverse mortgage, I'll tell you, because at that point there has been a lot of suffering. And when I check somebody's credit, I can, credit is it's like a resume or something. It tells you where you've been. And I can just see in somebody's credits years, in some cases, of suffering, financial suffering. And that is true suffering. But many, many, many more reverse mortgages are what are called reserve reverse, or standby reverses. And that's when somebody does a reverse mortgage years before they're going to need it. And why would somebody do that? Why would somebody set up a reverse mortgage line of credit if they have no financial need right now? The reason for this is one of the most significant elements of the reverse mortgage program. Whatever they have not used is growing month over month, compounding with what's called reverse mortgage line of credit growth. So if somebody started off with, let's say, $300,000 in their line of credit. So picture the pickle jar again. We're going to put a belt around the tummy of the pickle jar. They've got $300,000 worth of pennies available to them above the pickle jar. They don't need it yet, so they leave it sitting there. Whatever they have not used is picking up line of credit growth tax-free in their favor. And that's called a standby reverse or a reserve reverse. It's just being held there to appreciate. And that growth on that line of credit is statutory. It's not attached to appreciation on the home. Even if that home goes down in value, that line of credit will continue to grow. And we'll move away from the pickle jar image. Imagine a big lump of bread dough sitting on your kitchen counter. It's getting bigger and bigger. When you need some of it later on, you pinch off what you need, you use that, whatever's left continues to grow. So many more people do a reserve reverse or a standby reverse because they want another retirement bucket that is tax-free and it is going to grow over time. So that old, that poor, and that sick fallacy, Yes, it's not strictly a fallacy. There are plenty of people who are just absolutely at the end of the rope and they do a reverse mortgage, but far more people, as there's better education out there, far more people do the reserve or the standby reverse in order to have a tax-free bucket to draw on in the future when they need it.
Yeah.
And it's
again, a lot of,
tax-free.
yeah. And a lot of good things from that too. A lot of different stories that I've heard, on that is, well, if you own a home, eventually it's going to need some maintenance and repair, and right. So, you get it at a young age and you live to be 102, you might have to have a new roof. You might have to, want to remodel the kitchen, or let's say now you have to put some handicapped issues in the bathroom or things like that.
Exactly.
So this is great that you have that availability to do it. You don't need it now, but you may need it in the future. So that's a good one there. But I've actually heard where people have done that to where, the kids are saying, well, mom's had that house. We grew up in that house. It's not exactly the house that we want to live in. It doesn't want to be our forever home. We want our parents to stay there as long as they want to, but they don't want to really have that house when they're gone. And I've heard people that have actually taken equity out of their reverse mortgages and used it for down payments as gifts for their kids. So they can actually utilize that for weddings and things like that too. So I've heard some really good stories about the way that they can tap into that equity and use a little bit for something that's good or something that's happy that they wouldn't have been able to do had they not had that equity. And then they get to see, their heirs using it now rather than just waiting for them to enjoy it when they're gone.
Right. They call that a living
it's not, and we've kind of talked about this from the angle of medical, but are you saying that you can use this money for whatever you want to use it for? There's no restriction?
That is correct. That's absolutely correct. Yes, that money is theirs for them to use, and they can use it any way they want. As a matter of fact, on Saturday, the Saturday past, I was notified that a previous client of mine had just passed. Well, it's a client of mine about 15 years ago, and he needed a liver transplant. He had caught a virus that attacked his liver. He was not going to survive. And the cost for a transplant is enormous, absolutely enormous. So they did a reverse mortgage. They took some of those funds or they just actually had it sitting aside. And when a liver did become available, that was a match for him, they took some of that and covered some of the uncovered medical expenses. He went on to live another 15 years, lived long enough to see his
that's
youngest.
your asset working for you, for real.
Exactly. And now his widow is living in the home. She'll live there as long as she wants to. But yeah, that's the classic medical scenario. And I do a fair few of those. But like I said, by far and away, most people are either buying a home, an aging in place appropriate home using a reverse for purchase, or they're doing a reverse mortgage and getting it set up long before they'll ever need it.
Yeah. Yeah. So we can definitely see a lot of good things that can come out of the reverse, mortgage. And I think it really is just, that understanding. And again, I think sometimes we see it, on the other end when the reverse is done and it's time to, as you as an agent may say, yeah, now I got to sell this house and it's got a reverse mortgage on it. But again, if there's equity remaining in there, it still goes to the estate. It still goes, right? And they can still sell it like normal.
Yeah,
but the other thing is if they live to be 102, what if there's no more, then, what I'm hearing is there's no burden on the estate afterwards. If they happen to have a reverse mortgage forever, that mortgage is insured, right? Just like a normal FHA loan is insured against default. That mortgage is insured that if it doesn't owe enough money upon the sale to pay off the loan, that it's not going to be a burden to the rest of the estate or to any of the heirs. It's going to be covered.
Let's actually kind of tarry on that program for on that point for a second. So, and we're going to drive it to its extremes. We're going to take a scenario to its extremes so we can more easily parse out what that would look like. So let's say somebody did a reverse mortgage right at the age of 62 and they qualified for, I'm just making up numbers here. Let's say at 62, they qualified for $250,000. And then they go on to live to be 102 years old. And during that time, they've used all of the money they qualified for. Okay, so
$250,000.
And during that time, something horrible happens to the housing market. And now the house, when they did the reverse mortgage, the woman was 62 and her home was worth, let's say, $500,000, but now something terrible has happened to the housing market. And now all the kids can sell the house for is, think of something ridiculous, $50,000. That's all they can sell the home for.
I don't like this scenario.
Yeah, we would drive it to the extremes. And in this case, it wouldn't even be realistic. But when we hit the extremes, then you can really see what the issue could be. With a traditional mortgage, if they could only sell the home for $50,000 and the loan balance, because there's unpaid interest. Now let's say the loan balance is, I can't remember what my numbers were starting out, but let's say the loan balance was $350,000, the home can only be sold for $50,000. With a traditional mortgage, what they'll try to do, what the lender will try to do is put a judgment against the estate and collect from other assets.
Right.
With a reverse mortgage, that is not what happens. So if the home goes down in value, and in this case, we had the homeowner live to be really, really old, so it's collected years worth of interest, the loan balance far exceeds the home. So what happens? Well, you will still, as the real estate agent, the real estate professional will still sell the home. The home will repay whatever it can. In this silly scenario, $50,000. The FHA mortgage insurance pays off the shortfall regardless of how or why that shortfall occurred. So the home will repay what it can. The FHA mortgage insurance will pay off the rest of the balance due regardless of how that shortfall occurred. So they call that downside market protection. So if the market goes down, the homeowner, the heirs, and the estate are protected from having to shell out anything for what the home could not repay. The mortgage insurance covers the shortfall.
Right.
Wow.
And if it goes up in value, all the appreciated value goes to the kids.
Yeah. Yeah. So it's kind of like a win-win to the estate. So even if the parents left them, $500,000 in a savings or checking account or something else, they're still not going to come after that money for the shortage. It's still protected. They're still going to get the rest of the estate. It's not going to be a burden on the estate.
Right.
So
and all of us are probably in about the same point in life where we're worried about our aging parents. And, Darlene, you were hitting this a minute ago where you wanted your grandmother to stay in her home. You weren't really concerned about an inheritance. On the other hand, there are some types of elder care that will try to collect from the adult children, and that's a scary thought.
That is a scary thought, especially when you didn't have, as the adult children, you didn't make the decision, and they can come after you.
And we would do anything to protect our parents, of course.
Right.
But on the other hand, we as parents want to protect our children. And with a reverse mortgage, that's one thing you never, ever have to think about is whether they're going to come after you as the adult daughter for any shortfall occurred on the reverse mortgage. You're completely covered. Your mom's assets are covered. Your mom is covered. So there's and the federal wording says no deficiency judgment shall be assessed against the homeowner, the heirs, or the estate.
Right. Right. So they don't have to worry about that. And I think that's something that a lot of people really don't understand about the reverse either, is they're afraid that it might, they live forever.
Come back to bite them.
On the estate. And come back and hurt them. And that's why I said, no, that's what that mortgage insurance is there for, to protect the lender in the event that does happen, that they don't have the equity in there to cover it.
Yeah, the mortgage insurance with a reverse mortgage does indeed protect the lender, but it also protects the homeowner, the heirs, and the estate. So it's a much broader protection with reverse mortgage. Yes.
So another misconception that I have is you can be too old, because we used your grandmother as an example.
102.
She was 102. Can grandma, if she was still alive at 102, can she get a reverse mortgage?
Yes. So there is a minimum age. So for the FHA mortgage, there's a minimum age of 62. There's no upper limit. So my oldest client that I've ever had was this year, and she was 103.
And she made the decision to get a reverse mortgage.
Yes, for in-home care. And so once you get past the age of 80, most people are doing reverse mortgages for in-home care costs or to keep a spouse in managed care. So let's say managed care is charging $20,000 a month, and the homeowners have gone through all their money, but let's say in this scenario, the husband is in a nursing home. The wife has been writing a check for $20,000 for the last 18 months to the nursing home, and now she's gone through all their assets. So people do indeed do a reverse mortgage to take out some of that to pay for a nursing home for a spouse that can no longer come home. But Crystal, you ask a question, is somebody too old? The older you are, so we're going to go back to that image, that mental image of the pickle jar. You put a belt around the tummy of the pickle jar. The older you are, the lower down on the pickle jar the belt goes. And remember, the homeowner can access all the pennies above the belt. So the question actually becomes, can you be too old? Well, no, you can't be too old. But that suggests a different question, namely, is it smarter to wait until you're old and do a reverse mortgage? And surprisingly, the answer is rarely is it a good idea to wait because of that growth on the reverse mortgage line of credit. So if somebody does a reverse mortgage right at the minimum age, 62, just leaves the reverse mortgage untouched, by the time they are encountering illnesses, their line of credit has grown tax-free, and now it's a much, much, much bigger line of credit. So if you wait until you're older and do it, your odds of having already encountered some financial turbulence are much higher, and you've already drawn down your taxable assets, so you had to pay a big tax liability. If you had done a reverse mortgage, had set that aside, and now start drawing on it, that's tax-free, and you're much more likely to enjoy financial survivability in retirement. So people who do a standby, originate young and just leave it sitting there, financially are able to leave their children much more in many cases. I mean, there are no absolutes. And as women, we've seen it all. We know some people have late onset MS or a slow creeping cancer or Parkinson's or whatever. The truth of the matter is a lot of people end up going through not this or that, not a 401k or a reverse mortgage, but they'll go through all their assets, reverse mortgage and a line of IRA or 401k. They'll go through everything. But our hope and prayer as parents is that we won't go through everything. We'll be able to leave something to our kids. But most of all, the thing we don't want to leave our kids is a debt. Yeah. Right. And with a reverse mortgage, the statistics are out there that you do statistically stand a better chance of leaving your kids without a debt to square up with once we do, finally pass. So great question on that. I love that question. Does it make more sense to wait until you're old because you get more pennies above the belt? And the answer is, in general, no. You fare best, originate young, and then just leave it sitting there.
Wow.
Yeah. So it's kind of it's a part of an overall financial plan, right? It's not the only financial plan that you want to have. And that's where we see a lot of people use the reverse mortgage is when, maybe they failed to plan. And this is the way that will really help a lot of them, like you were saying, that we're struggling, that, you can tell from their credit report, they've already used through everything that they have. The great thing about the reverse mortgage is they're really not looking at your credit history. They're really not looking at the credit score per se, correct? So that anybody who's in a hardship can still look at a reverse mortgage for an option, but that you could also use it for good and use it for part of your long-term financial.
Right. I want to address that a little bit. And, it's to be tacky about it, the crappy credit scenario. So a bad credit history has, it often can be the deciding factor as to whether somebody can qualify for a traditional mortgage. With a reverse mortgage, it's not the score we take into account. However, we do have to take credit history into account. And this is why we have to show that they can make the minimum payment on their credit cards every month, because no matter what kind of mortgage you have, you still have to pay the minimum balance on that credit report. So on those credit cards. So what happens if somebody has a really, really bad, just very bumpy payment history, or they have defaulted in the past on their property taxes or their homeowner's insurance, or they didn't keep up with their mortgage? Can that person move forward with a reverse mortgage? And the answer is yes, probably, though here's what happens. So go back to that image of the pickle jar. We're going to put a belt around the tummy of the pickle jar based on their age. If they have a bad payment history, particularly on property taxes or homeowner's insurance, we may have to hold aside some of that line of credit in a great big, what's called life expectancy set aside. So we take their future taxes and their future homeowner's insurance, we multiply that times their life expectancy, and we have to set that aside. You can think of it as a big escrow. It's not technically an escrow, but we have to set that aside. And then we, as the lender, will pay the property taxes and homeowners insurance moving forward to just ensure, absolutely ensure that the homeowner does not in the future fall behind on those property taxes. Because again, almost the only way you can lose a home with a reverse mortgage is by failing to pay your property taxes. So we have to force the issue and say, can't happen on our watch. We're going to pay your property taxes and your homeowner's insurance.
So they don't necessarily deny you, they just protect it.
Exactly. We have to make sure that not only can we refinance this home, but the homeowner can stay in that home, even if, few people have a better memory 20 years on than they did, in their 60s. So somebody already had problems paying taxes when they were in their 50s or 60s. By the time they're in their 70s or 80s, it's likely to not have gotten better. So now we pay the property taxes, we pay the homeowner's insurance, and then they're good to go. And so whatever's left in that pickle jar above the belt after we've set aside that money for the life expectancy set aside, that's now going to be their line of credit. So
Wow.
That's how we move forward if somebody has a very spotty history with paying.
Right. So the key is to think about this before you get in, if this is an opportunity, maybe talk to somebody about it before you get into a financial hardship to try to prevent a financial hardship for you. Yeah.
And that's going to be a very small minority of people that we have to do that on. It just is not it's not super common. In general, people are still financially well, healthy. Many of my clients are still working. They're setting up that reverse mortgage. And you're right, Darlene, in conjunction with a much bigger wealth management plan. So they're doing wealth management. A lot of my clients come to me through financial advisors, and the financial advisor is saying, okay, we're going to, structure your wealth plan, your retirement plan, including a reverse mortgage.
Yeah.
This is a really good and really deep topic.
It is.
It is.
Yeah. I'm glad we got to, and this, I'm glad we had Laurie on again. I do mortgages and know about reverses, and I've referred a lot of people, and I think it's, a great thing. But when you really kind of dig down into misconceptions and things, you did a great job at helping us explain the reverse mortgages, and we really appreciate your time.
Yeah, and I can't emphasize enough, anything anybody says, it's like, yep, I've been right there. So it's like absolutely no judgment zone.
Yeah.
Let me hear whatever you are thinking, and then we'll just kind of review it.
So, Laurie, did you want to share some contact information, email or phone number, or, because you're the expert.
Yeah. You can Google either my name, which can be a little tricky, or you can go to reverselady.com. I have a website at reverselady.
Reverselady.com.
That's how long I've been doing this. I didn't even realize that was an extra fun website. But so reverselady.com. And I am licensed in Arizona. I'm licensed up and down the East Coast.
Excellent.
And so if anybody has any questions, absolutely.
Yeah.
Definitely.
Yes, or you can
reach out.
Contact Darlene or Crystal. So, and then just kind of the one last thought is I want people to bear in mind that if they're in a home right now that's not working for them and they've got to relocate, to consider reverse for purchase, because it solves a lot of problems that just otherwise can't be solved.
Yeah. And I do see that a lot more, in today's world, where more people are staying in their house as they're aging, and they can't do the stairs anymore. They need that. So we are seeing people that are downsizing and buying houses, and it's just nice to know that you can do this reverse purchase at the same time. I did have an example where somebody was only going to make like $100,000 off the sale of their home. Well, they couldn't find anything for $100,000, but that really helped them in the reverse mortgage purchase be able to get to a much better home. So I really think what we're going to see a lot more of this reverse mortgage purchase in the future as well.
As the good word gets out.
Yeah.
I haven't seen anything negative, from what we've learned today. Even the misconceptions are just that, misconceptions.
Yeah.
Past abuses of the concept.
Yeah. Wow.
Awesome. This was
Well,
amazing.
Laurie MacNaughton, is that MacNaughton?
Yes, yes.
Yes, reverselady.com.
Coffee and Keys is brought to you by Darlene Kemp, VP, Senior Loan Officer, NMLS ID 173897. Atlantic Coast Mortgage, LLC is an equal housing lender. NMLS ID 643114. www.nmlsconsumeraccess.org. And Crystal Jacques, Realtor for both RE/MAX Allegiance, 4000 Virginia Beach Boulevard, Suite 164, Virginia Beach, Virginia 23452. Office phone 757-490-7300. And RE/MAX Professionals, 20,241 North 67th Avenue, Suite A1 Glendale, Arizona 85308. Office phone 623-362-3000. Each office is independently owned and operated and supports the Fair Housing Act and Equal Opportunity Housing.